treats for tech investors this Halloween, but is AI spending getting scary? This was the week big tech needed to show investors that enormous spending on AI is paying off. The hyperscalers' quarterly results were a mixed bag. Apple forecast double-digit sales growth for the iPhone, and a 20% rise in cloud revenue sent Amazon shares up about $330 billion in after-hours trading. But Meta lost $200 billion in market value on Thursday after Mark Zuckerberg's AI spending plans spooked investors. Meta, Google and Microsoft collectively spent nearly $80 billion on AI development and infrastructure in the last quarter. But are they testing investors' patience? Laura Cooper is global investment strategist at Nuveen. Laura, some of the spending promises for AI capex that we've heard this week are enormous. Is the market really on board?
Well, that does seem to be the dominant theme so far this earnings season. I mean, if we look at the hyperscalers alone, they're estimated to spend $350 billion this year on AI investments. That's a 42% increase from last year, and it's expected to continue to increase next year. So markets at this juncture do appear to be on board. I think the key question, though, is how much longer are investors willing to pay a premium for these stocks until they start to see an actual substantial return on some of these really eye-watering type of numbers when it comes to the AI build-out?
Absolutely. And why do you think investors aren't more concerned yet about whether AI is delivering profit?
I think there's still this underlying confidence that AI is the future and that these will have substantial returns on investments. And I think that's why investors are willing to go all in on this AI theme. I think we'll be watching for a couple of key factors for when this may turn. The first is around, we've seen a lack of leverage to fund this AI spend. If we start to see more increase in terms of debt to fund these, I think that could be problematic, because right now it's really been driven more by the cash flow side by firms that have healthy balance sheets still. And second, we will be watching for any signs of these firms actually signaling that they're going to pull back on this AI spend. That will happen certainly at some point, but that could signal to markets a turning point. So I think we're watching really for those two key dynamics. Perhaps that could be a 2026 story, but certainly not by the end of the year.
The hyperscalers do have healthy balance sheets, as you say, but the word bubble has been on a lot of people's lips. Should the tight concentration and the circularity of many AI deals make the market nervous?
That's the active debate in the market right now. Are we seeing an AI bubble? I mean, one could argue potentially we are, but we're not necessarily seeing it driven predominantly by speculation, which is really a key underpinning of a bubble. Instead, we are seeing the fundamentals backing this rapid gain, and that's being driven by the earnings that we're seeing come through. To your second point, I think concentration risk is certainly something to watch for. I mean, a third of the S&P 500 market cap is based on 5 companies alone. And I think increasingly we are seeing investors want to diversify away from that tech concentration in the US. But of course, you still have to have that exposure, because that's really what's been kind of the key driver of gains in the US so far this year.
One person who said this isn't too speculative yet was Jerome Powell this week, but he sounded pretty cautious about the US outlook in general, disappointing for markets who were hoping for a December cut. Could the Fed now be done for the year?
I think that certainly is a risk, and that's actually our forecast as well. And I think, Chair Powell did highlight the fact that because there's this dearth of data because of the US government shutdown, that does warrant them taking a more cautious stance. So they will probably, want to wait until they have greater clarity on the economic backdrop. And he also alluded to the fact that they are seeing an improvement in conditions relative to their last meeting, which again does warrant a policy pause. I'm surprised by markets being surprised as much as they were by him pushing back on that December cut. And if anything, I think we're probably in for a more gradual easing cycle than even now markets are currently pricing.
As you say, given the shutdown, we don't really know what's going on with US inflation, but we expect that data to look quite stubborn. Are policymakers ready to accept it settling quite a bit above the 2% target, do you think?
I think at this point, potentially the Fed is certainly attuned to the risk that inflation could accelerate on the back of tariff-led price pressures. And I think Chair Powell did strike a relatively balanced tone this meeting. Previously he did say that the balance of risk had shifted more towards the labor market, but I think there's still kind of that inflation dynamics still at play. So I think perhaps the Fed, that's one of the reasons why they're not going to kind of give in to that market pricing for easing. coming. I think the key risk, though, is when we see that change in the chair next year, the composition of the FOMC, markets are really pricing in a more dovish regime when we start to see that come through next June. I think that's really the crucial thing to watch for next year.
That was Laura Cooper of Nuveen. Don't forget you can watch more videos on Reuters.com.